Hey guys, Zoeb here from OneGlanceTrader.com and welcome back to part 4 of my very own Forex Scalping strategy course. Now again, if you've just stumbled across this video, I strongly recommend that you hit the link in the top right hand corner or the first link inside the description to view the playlist so you can view the course in its entirety from the beginning, because I've already gone through the whole strategy in parts 1 to 3, and even though risk management, this video itself will offer a lot of value to you, it makes more sense for you to really start from the beginning. So I strongly suggest that you did that. So as I just mentioned in the last part, we went through the rules and the mechanics of when to place a buy and when to place a sell. So in this video, we're going to talk about everything from stop loss to lot size to take profit targets and the overall kind of risk management of scalping in general and this actual strategy itself. So the first thing you need to do whenever you decide to pull the trigger and do a buy trade or a sell trade is you've got to understand where your stop loss is going to be. Now, for me, I like to use the ATR, whether I'm trend trading, counter trend trading, long-term trading, scalping, whatever it may be. The average true range is probably the most popular way of determining where your stop loss should be. And the reason why we use the ATR is mainly because it takes into account the current market conditions and the volatility in these market conditions, and you can kind of set your stop loss outside of that kind of quote unquote noise that the market is producing. So there's little swings and stuff that it does, because we don't want to get stopped out or spiked out when we're in the trade, especially when we're scalping, because we want to give it some time to breathe to allow it to do what we want it to do. So you can see here at the bottom I've got the kind of ATR, and this will be in the standard template for this kind of overall strategy that we're talking about. And basically what it does, it just goes up and down, taking the average of the high and the low of X number of bars that you decide to give it. And the default traditionally that is used is 14 periods. So it takes the last 14 bars, adds up the highs and the lows, and then gives you an average over the 14 bars. So in this example here, you can see that the current reading is 0.0624, which in other words is 6.2 pips. So over the last 14 bars, price has moved up or down around 6 pips. So knowing that information, how would you set your stop loss? So generally what I like to do is, when I'm looking at from a scalping perspective, I like to set the stop loss 2 times the ATR value. So in this case, 6.2 pips would be 12.4. But as you notice that I've put rounded up to the nearest pip, because when we go on to calculate lot sizes, we don't really want to be looking at decimal places and things like that. So that 12.4, I'll round that up to 13 pips, give myself a bit more room, which is why I round up as opposed to rounding down to 12 in this instance. And as I said, 12 pips is double the current conditions, or 13 pips rather, is over double the current market conditions of this particular kind of pair of where this a screenshot is taken. So price, the bit you got to remember is the ATR doesn't tell you the direction of where price is going. It ain't going to go up 6.2 pips or down 6.2 pips. It could be either down or up. It's not a directional indicator. It's just a measure of volatility. So again, I tried to keep this very simple. Whatever, just before you pull the trigger, have a little reading on what the ATR is, times it by 2, and round up to the nearest whole pip, and therefore that will be your stop loss. So I hope that really makes sense. And then this will help us, in calculating your lot size. Now, a lot of people have different views and opinions around, of how much you should be risking per trade. The kind of consensus is, and what I normally do when I, do kind of longerish term trading, my trend trading, and all that kind of good stuff, is I don't risk more than a percentage of my overall account. So traditionally, it's between 1% and 2%. However, when I'm scalping, I prefer to have a fixed monetary value as opposed to a fixed percentage value. So if we take an example, let's just say, I've got a £2,000 account and I'm willing to risk £10 per trade, because again, you've got to remember you'll probably be doing a lot of trades depending on how loose or how strict your settings are. But again, you should be getting a lot of signals, especially if you're working on the lower time frame. So let's just say it's £10 I'm willing to lose per trade. So we learned in the previous slide that the ATR, your stop loss should be 2 times the ATR. So let's just say, for argument's sake, that the ATR reading was 10 pips. So times that by 2, we know that our stop loss needs to be 20 pips. So now that we know how much we want to risk, so we know we want to risk £10, and we know that the stop loss is going to be 20 pips away from price, we then can calculate our lot size on how much size we're actually going to put on this trade. So in this example, you do your amount you're willing to lose, in this case £10, and divide it by your number of pips your stop loss is going to be, which is 20. That gives you a lot size of 0.5, which is 50p per pip or per point. So then then when you're going to go place your buy or sell order, you would put 0.5 in, place your order, and then open up that order again, and then set your stop loss 20 pips away after you've placed the trade. So I hope that makes sense. It's relatively straightforward, and again, I like to use a monetary value as opposed to a percentage value of my account only when I'm scalping. Just want to make that clear. So we've done our stop loss, we know what our lot size is, so we've put the trade on. Now what we're trying to do is we're trying to calculate where should my take profit target should be. Now traditionally, when you scalp, you're generally going to have a negative reward to risk. It's very difficult to extract a few pips out of the market and have a positive reward to risk. It can be done. There are traders, that scalpers, that only trade on a positive reward to risk ratio. However, generally you are risking more than what you're looking to gain. Now, in stating that, how are we going to set our take profit target? Now, traditionally, what I would normally advise to do at the beginning, if you're very new to trading or new to scalping, is aim for a take profit of 1 times the ATR. So if we look back at the previous example, if the ATR was 10 pips and you had a 20 points stop loss, your take profit target would be 10 pips. So therefore, it gives you a reward to risk of 1 to 2. So I'm looking to gain £10, but I'm willing to lose 20. And with that kind of ratio of reward to risk, you need to be hitting at least 70% win rate to be profitable. Now, with a scalping type of methodology and with the rules and the framework behind this strategy, you should easily be making 70% win rate. And again, in the next video and the final video around premium trades, you should be getting to the 80s and 90s. One little tip that I'm just going to share with you now is, when you start becoming more advanced with this, you're more comfortable in placing the trades, setting your stops, setting your take profit, and the more trades you kind of have that you've gone through, the more comfortable, and you'll understand how price moves a bit more, is what you can do to improve your reward to risk is set your 1 to 2, so risking risking £10, risking £20 to go make £10. But what you do is when it's made your 1 ATR, so you don't actually set a take profit target. You wait until it goes in the, let's say an example, 10 pips in your favor, which is 1x the ATR. What you then do is you move your stop to break even, giving you a risk-free trade. And if price then continues to go further in the direction that you're trading, then just keep moving your stop loss behind price and trail it, and eventually get stopped out buy price retracing and hitting your stop loss. That is something that I do a lot now. You do get a lot of scratch trades, so a lot of trades that hit your 1 ATR and then reverse back and then straight away hit your hit back your stop loss and will scratch you out at a break even trade. That's fine. It's fine. That is not a problem whatsoever, because the ones where it does continue to push, 2x, 3x, 4x the ATR or your initial take profit target, that's when you're going to start improving your reward to risk and hopefully get it more to a even split from that perspective. But again, to keeping things very simple, your stop loss is 2x your ATR, your take profit target is 1x your ATR. As you get better, when you hit your 1 ATR, you don't set a take profit target. Just wait till it gets to 1x ATR, move your stop to break even, and then start trailing price as it goes further and further inside your favor to get a better reward to risk ratio. So that is overall the whole main concept that I wanted to talk about for risk management. You now should start seeing the end screen now for the thumbnail for the last part of this course, which is A++ premium trade setups. Again, we talk about some very optimal settings, the settings that I personally use now to trade this strategy. And then again, I go through one final example that goes through the entry, the stop loss level, the take profit level, the lot size, and then we're going to see what happens at the end of that trade. So click that thumbnail now for the final part of this course, and I shall see you guys very soon.